Good afternoon, everyone. Thank you for joining Astoria's ETF Table Talk. John Davi, I'm the founder, CEO, and CIO of Astoria. With me, I have a very good friend of mine, somebody I've known for many, many years, Tony Kelly, who is the co-founder of BondBloxx. Tony, welcome to ETF Table Talk.
Hi there. Thanks for having me.
So, Tony, you and I have known each other for a long time. You have a very long, illustrious career in the ETF ecosystem. Maybe just start with kind of BondBloxx's, like what you all are trying to do,
Sure.
and that would be a good start.
Sure. Yeah. Thanks for having me. And as you mentioned, been involved in ETFs since 2000. Was at iShares for um, 15 years, and then was at Goldman. And while at Goldman, my partners and I, who were also at iShares, were kind of looking at the market and we're discussing kind of the opportunity that wasn't being taken advantage of or wasn't being focused on, which was fixed income ETFs. There was a couple of things that we had noticed in the 2019, 2020 timeframe, which was the regulatory rules had changed, 6C11, which was one of the bottlenecks that I think the SEC unknowingly put in place in terms of launching and managing fixed income ETFs, and they made some changes to kind of modernize the rules. So that was going to make it easier for managers to manage the product, or new managers to manage the products. We also were noticing the infrastructure was changing, sort of the disconnect between sort of the equity trading desks and the fixed income trading desks that need to come together to make markets and provide liquidity. That in 2002, when we launched the first fixed income ETFs at iShares, that infrastructure didn't exist, and those market makers and market participants didn't really work together. But over the course of time, there was more and more technology, more and more connectivity, and it seemed like things were definitely starting to get together. And one of our CEO, Leland Clemens, was at TradeWeb in that time frame, and he was just noting the electronification of the bond market and thinking that this looks and feels a lot like the 1990s, where bonds are now trading in baskets. They're using sort of algorithms to trade fixed income, all of which seem to be the underpinnings of sort of more ETF usage, which we were also kind of seeing in our own careers with clients, that clients seem to be more inclined to use ETFs. So in 2021, we got together and decided that we would launch BondBloxx, which is a firm that is focused on fixed income ETFs.
You're the only firm, right? The only pure fixed income ETF issuer.
Correct. Yes.
I find that very helpful. So, for us, as we are managers of ETFs, ETF models for other financial advisors, I just, when I think about like cryptocurrency, right? Like I want the cryptocurrency manager to have like deep expertise in crypto, because I just think it's a very nuanced area. I feel like the same thing for fixed income. People seem like, oh, it's not a big deal, anyone can do it. And again, like the big behemoths, BlackRock, they already have fixed income divisions, right? But I like the idea of like a dedicated fixed income manager if you want like targeted specific exposure to, fixed income.
Yeah, no, I think that's right. And that's what we were thinking, the same thing. It's by constraining ourselves, our careers were multi-asset, but by constraining ourselves, we thought we could be more innovative, right? We thought we could be deeper and better experts. And we thought if we just did fixed income all day and that was the only thing, then interesting things would come from that. And so far, I think that's played out. I think we've had great success with resonating with clients sharing with us great ideas of like what to do from a product perspective, feedback on enhancing existing products, which is kind of an interesting thing. And I think as we basically continue to grow and develop and build this reputation, hopefully it builds on its own.
Yeah. And you have a chart that you were showing me before. It'd be great for you to share that I can make you such that you
Sure.
can do it. But how about like the growth of fixed income ETFs now versus history?
So just to level set a little bit, there's roughly $1.5 trillion in fixed income ETF assets today, um, which sometimes seems kind of small relative to where the equity ETFs are, which is at about $6+ trillion. Can you see my screen here?
Yeah, we see it.
Okay. So when you lay it out like this on comparison, you know, we get this question sometimes. It's sort of surprising, like given the size of the fixed income market, it's so much bigger. Why isn't it? Is this sort of a sign of the product not being successful? But I think they got to sort of put it in the historical context that equity ETFs had about a 10+ year head start. And when we do a time zero analysis, basically overlay the initial fixed income products that were launched in 2002 with the initial spider and basically make that time zero and kind of track it forward. We're in year 22 of the sort of since the first fixed income products. And you can see it's not quite where the equity markets are, but it's kind of roughly the same. So in year 22 is when equity ETFs went from about 1.5 to $2 trillion. We're there live market right now. So, it's kind of tracking sort of the same thing. We also think this is similar to the equity market, kind of the beginning of the hockey stick, right? Where sort of there's just more client adoption, there's more client usage, the infrastructure has been built out, which is also kind of parallels the equity market.
Yeah.
And we think there's going to be some real growth here in fixed income ETFs.
And that's an interesting chart. And Tony, you and I know each other, from my Morgan Stanley days, and you were at iShares, and I think macro, and
Yep,
I just can't help but think like when you go from like zero Fed funds to
that's
5%,
right.
like, there's now a catalyst for investing, right? Because when Fed funds is at zero and you got people buying high yield bonds for 3%, like it just feels like the world is really open up from like a macro
So
standpoint.
true.
Yeah.
Yeah, so true. Yeah, and this growth has been in that zero, low volatility kind of environment, which is kind of not where you would typically basically invest in fixed income, right? You would invest in sort of equity markets where the, returns would be higher and the risk would sort of lower. So in this higher volatility environment that we're in and higher interest rates, yeah, that's sort of a tailwind for fixed income for sure.
And then just to get, because I know you're like in the weeds, right? And I do want to get in the weeds for people that want to get deeper. So, you've got like, whether it's Shy, IEI, you've got this, roll-in maturity ETFs from, iShares and Vanguard, let's say State has
Right.
their own. And then you guys and FM Acceleration came out with like fixed maturity, fixed duration.
Right.
So a lot of nuances there, but why don't you spend a couple minutes just talking about how important it is to have like a very targeted
Okay.
fixing approach.
Sure. Yeah. I mean, um, the sort of first products, like the first four fixed income ETFs were LQD, SHY, IEF, and TLT. And IEF, TLT, and SHY are treasury focused. So it's 1 to 3, 7 to 10, and 20 plus. Those indices were based on the Lehman indices at the time, and it was a pretty innovative thing in 2002 to be able to take an equity wrapper and put fixed income instruments into it. That being said, those indexes may not have been uh, built for the purposes of being investment vehicles. They were basically just the existing indices of fixed income indices that were available at the time. So it's one of those examples that I think the market, based on feedback, those products are sort of fine. You can think about them as sort of the 1.0 version, but over time, based on client feedback and sort of different use cases, they've evolved and developed from there. So instead of the maturity buckets that we call them, others have come out with bullet shares. I think these type target roll down products that mature. So they were almost like investing in a bond. We launched a suite of products that you're right are similar to the target maturity products of FM. Ours are target duration. From our experience working with advisors and working with institutional investors, there's a couple of reasons investors use fixed income ETFs. One of which, the obvious one is sort of cash flow income that is needed and or wanted in a portfolio. But another big use case is managing duration in their fixed income portfolios. So if they have a target duration, maybe they're setting it the same as the AG, let's say 5 to 7 years or wherever the AG is at that point in time. They make a conscious decision of, do they want to match that duration? Do they want to be longer than that duration? Do they want to be shorter than that duration? And the instruments in the market, basically the maturity bucket products or even the maturity focused products, are kind of imprecise that way, that duration and maturity are not the same thing, right? So maturities is when the bond matures. It's basically when the end of the collecting the coupon period, and when you get your money back, that's maturity. But duration is more thought of around the sensitivity to changes in interest rates, right? So when you kind of think about a 10-year coupon bond and a 10-year zero coupon bond, a 10-year zero coupon bond will have a duration of 10. A 10-year coupon bond, because it's paying you some coupon, has a lower duration, depending on how high that coupon is, where interest rates are. So if you're looking to extend duration on a portfolio by buying a 10-year instrument like our X10 product, X10 rebalances every month to bring it back to the duration that it is stated in the index. If you're using something that's not actually targeted duration, you might end up with a duration of 9 years. It's even a little bit more extreme when you kind of go longer duration, longer maturing. You look at kind of TLT, which is the 20 plus. I don't know if it would surprise you to hear, but the duration on the 20 plus product, the last time I looked at it was about 16 or 17 years. So it's multiples less than I think what you would expect. And the impact of that is, if you're investing in that or sort of buying that to express a view on the change of interest rates, you might end up with sort of a somewhat different return. If you might be right on the call of where interest rates are moving, but the implementation tool may not sort of deliver the result that you want.
Yeah, that's a classic example. I mean, that happens all the time. Even when in equities, I would argue that people buy some type of product because they think it's low volatility, and then all of a sudden they get 40% in two sectors, and it becomes anything but low vol. The bond side, I mean, there's this term of convexity and like the rate of change, which the longer the maturity you go out, the greater that rate of change is. So
That's
yeah,
right.
I think it makes a lot of sense. And you guys have priced it pretty competitively too. So kudos to you for doing a lot of good things. Obviously, everyone wants to pay virtually nothing these days, unfortunately. So you do need to scale, and you guys have been able to scale. But you guys also have like an emerging market product too, right? You have some tax aware products you were telling me.
Right. That's right. Yeah. So, I mean, the suite, we started out with high yield. So we've got high yield sectors. So you can think about like the equity sectors, like energy, high yield, sort of like healthcare, TMT. Those were our first suite of products. Then we launched what we refer to as the ratings products, right? So you think about the high yield ratings categories as double B, single B, and triple C. Triple C's, for example, right now are yielding, as of this date, like 12+%. They're the highest risk component in the high yield market, but they're also the highest yielding. If you had a view of wanting high yield but not as much risk, double B's might be interesting. When you buy a broad-based high yield product, you generally get all three. We launched XEMD, like you said, an emerging market products. We've got treasuries, but our most recent launch is TAXX, TAXX, which is a short duration product that optimizes for after-tax returns. So for those investors that are either investing in munis or thinking about munis, this is an interesting alternative because the portfolio managers for tax, in addition to doing credit analysis, it's actively managed. They also factor in what is the after-tax return, and it's not always best to buy munis on an after-tax basis. Sometimes it actually makes more sense to actually pay the taxes, and you end up with sort of more, and that changes over time also based on cycles and market dynamics, and the PMs are singularly focused on that to optimize that.
You want to go into that a little bit more, Tony? Like, what do you mean by
Sure.
sometimes better to buy a muni versus what, like a corporate bond or
Yeah,
treasury?
that's exactly right. Yeah, so like the example we use sometimes is just to kind of bring it home is, would you rather earn 10 and then pay 4 in taxes and have 6, or would you rather just get 5 and not pay taxes on the 5? Right? You would more likely like to buy the 10 and end up taking home 6. And that's sort of the way to think about munis. Will pay you an after-tax return, but there's a cost to that, right? That it's not yielding as much. But sometimes munis do make sense, right? On an after-tax basis for high net worth or high tax investors, it might make sense. But doing that analysis and sort of thinking it in those terms is what this strategy does. So tax is always going to be at least 50% munis in the portfolio. Just to put some numbers on it right now, the tax equivalent yield for tax is over 6%. And on a product that has a duration of about 1.5, that's a pretty compelling kind of instrument right now, and this sort of speaks to the mixing of sort of the taxable and the non-taxable.
Where would you say people are using the tax aware versus like the fixed duration? Like how are people thinking about that, from a portfolio construction? Are they just doing their macro top-down research first and saying, okay, I've got a view on duration, so let me buy this, for this taxable account, but the tax aware account is only for, like, how are people thinking about like where BondBloxx fits in their portfolio?
Yeah, that's a good question. So it's a new product. So where clients are using it, I mean, we've raised $40+ million, so it's definitely I think the clients that we're talking to the most are those that are either muni or muni fund investors. I think is where most of our conversations are right now, because this is intriguing to them. The idea, they're tax sensitive, they want to basically optimize or increase the after-tax yield, and to date, the way to do that was just by munis. But this is sort of interesting. These statistics are interesting to them, that maybe in certain circumstances it makes more sense to pay the taxes. So I think there's that subset. There's also the broader category of, it's a short duration product, and there's a lot of advisors that are just looking for short duration. And this becomes interesting to, especially when you calculate the after-tax yield. So when they're clients that have, so it might be an alternative to like a Mint or a NEAR or JPST, something like that. When you sort of think about it in an after-tax basis, it is compelling there as well. So those are the kind of 2 use cases that I think we're sort of looking at right now.
Got it. You said before, high yield sector ETFs, and I think you were at iShares when iShares launched that, like, 10, 12 years ago. Would you say back then the market wasn't ready for like sector fixed income sector ETFs, and now there is because of that time
Great
series
question.
chart?
Great question. So the products that we launched when I was there were investment grade sectors. And I think it's a little bit of like the market wasn't ready, right? That might have been too much innovation too soon. But there is a difference between the dispersion of returns in sectors, high yield sectors, that actually doesn't exist in investment grade sectors. So investment grade sectors are much more correlated and much more correlated to changes in interest rates. So there's spread products, but energy and financials are more highly correlated than they are in high yield. And it kind of makes sense because when you kind of think about high yield, you sort of think about them also in terms of kind of equity-like returns with lower volatility, and the equity market has that dispersion of returns between sectors. So there was definitely, I think, an element of, I can't even remember when they were probably launched 15 plus years ago, those products. So it might have been a little early, but it was also maybe the wrong asset class to cut into sectors. There wasn't enough dispersion or enough differentiation in the return to matter. But yeah, it's interesting.
Got it. And then, so, you've been a visionary, you've been in the ETF ecosystem a long time. Where would you say fixed income products, like where we could see more products going forward?
Sure. A trend, and this isn't fixed income. This is probably more broad, but I think active, and you just are sort of seeing it, right? The flows into active ETFs, the filings, new product launches, the new entrants into the marketplace are large active managers. So I think active is definitely one of the bigger trends over the next leg of growth here, right? So for probably the majority of the first 20 or 25 years of ETFs, it was beta, it was sort of index-based products, and there were definitely active products, but they weren't sort of bringing in assets. Right now, it's much more of a level playing field, and I think that'll continue to play out because advisors want different things, right? For different parts of their book of business or for different clients, they want different alternatives, and fixed income offers that. So that, I think, is one of the bigger themes I would sort of envision play out over the next 10, 20 years.
Got it. We were asked the other day, because again, we're a sub-advisor, we manage ETF models, and we're like, okay, what do you think about, we were asked about the fine art ETF and should we allocate to that? And there's always this, cybersecurity, these like ETFs that you just know are never going to like survive. Does fixed income have that? Like, does fixed income have like these real niche, wonky, you know?
Yeah, it's interesting. In a lot of ways, like fixed income, I think is kind of undeveloped and maybe in some ways a bit less creative. Like the sort of whole thematic ETFs is kind of an equity phenomenon right now. I don't know. It does not exist in fixed income ETFs right now, but maybe that's something. I mean, I guess I would ask you, like, your clients need
The only thing I would say that's like wonky was like, let's say, I think one
music
point in time,
ETF.
Bed Bath & Beyond was like on the verge of like bankruptcy. So you could buy their, 3-year bonds, 5-year bonds and get 25% yield, or, so something like that. Like I can see somebody being like, oh, well, we'll buy these super juiced high yield bond ETFs,
Super distressed. That's a good idea. I mean, that's
Listen, I never thought a triple levered ETF in a very unique, specific industry would ever raise gargantuan assets. VIX ETFs, 2 times VIX, vol, cybersecurity. I mean, fine art. The fine art ETF has almost $1 billion, I think. Like, never would have expected that.
What about single stock ETFs, right? Single stock ETFs was an April Fool's joke email like 20 years ago, right? Like I think ETF.com had like a little joke of single stock ETFs being launched, and fast forward, like they're successful, right? There's a need, right? The leverage that it offers, the inverse nature that also it's efficiency, and that's kind of, I think, the common element in successful ETFs is it making advisors lives easier? Is it giving them better access more efficiently, right? I think that's sort of the common thread between gold, fixed income, international. It's just a lot easier to buy your US listed ETFs than to have to navigate gold bars, navigate currencies in emerging markets, or go pick, high yield bonds. Go like how to build that diversification. ETF in one quick trade gets you all of that.
Yeah. Yeah, I mean, definitely it's a innovation, for sure. Well, thanks, Tony. We're bumping up against the half-hour mark. Any other concluding thoughts that you want to leave our listeners? I mean, this has been a real treat to have one of the original ETF godfathers.
Thank you. Coming from you, who's I guess a fellow godfather for sure. No, I appreciate for you having me on here, and I love talking fixed income ETF. So thanks for listening to me for 30
Yeah.
minutes. Appreciate it.
Yeah, for listeners, so Tony Kelly was a big guy at BlackRock, and BlackRock is basically every sell side firm's biggest client. And Tony was like, we want somebody at Morgan Stanley to write macro research and apply ETF ideas. So we were given the order, and I went ahead and did it. And basically, that was like the start. The tipping point in my career was this idea of like macro insights, so applying macro content with ETF investment ideas, and that led to like the 10 ETFs report, which we do at Astoria. I did at Morgan, and it's kind of how we think about the world and how we built our business here at Astoria. So I always say Tony and Matt Markevitz are the guys that kind of started that trend for me. So.
Oh, thank you. Actually, it's funny. I tell the story that you were doing the research. We saw the research and said, like, he should be using ETFs in this research, and basically, brought it to you. So thank you for what you did, because I think it's kind of continues to be replicated. And I think it helped a lot of investors think about how to sort of implement based on, macro ideas and how to make it tangible. So
for sure.
Great relationship.
All right, Tony. Thank you very much for your time and appreciate it.
Thanks, John. See ya.
See ya.
Bye.